$50 million.
$10 million.
Over $1 billion.
A decade of easy money.
It was a Ponzi scheme, no doubt about it.
Then the bubble simply burst.
I was in shock. We were all in shock.
It was rough and it's going to be bad.
A complete roller coaster.
Now, in the wake of destruction,
You look back and say, what was I thinking?
David Faber reports The Bubble Decade. This weekend at these times on CNBC.
Welcome back. It's a Wednesday morning here on Squawk Box Asia. Now, how should you position your investments for retirement? And what investment choices should you be making if you're lucky enough to be retired? That's the focus of our Protect Your Wealth segment this morning. To help us out, Kim Walker joins us. He is founder and also CEO of Silver, an investment advisory. He joins us here at our Asia headquarters. And still with us out of New York is Phil Silverman, managing partner at Kings View Capital. Gentlemen, both of you, good to have you with us. And Kim, welcome on the show. When we think about investments from the perspective of retirees or people getting set to retire, you think safe, steady cash flow, good yield. Is there anything different that you're bringing to the table?
Well, I think you would normally say that, yeah. The difference that we have now is, of course, that most of the retirees or people approaching retirement have just suffered huge losses over the last 12 months.
Yeah.
And the thing that distinguishes an older investor from a younger one is the recovery time. You know, if you lose 20% of your wealth when you're 30, you've got another 30 years to get it back.
Yeah.
That's quite a different story if you're 55.
All right.
So it is true that older investors tend to be more risk averse, naturally, you know. But right now, the conundrum is, yes, they need to be risk averse, but they need to try and catch up.
Okay.
So the big issue, I think, is do they hold them? Do they fold them? Or do they, you know, increase their bet?
And what's your best advice?
Well, you know, my advice would be to, you know, if you can recover much of what you lost, to fold them and reassess your asset class, reassess the way you've invested that money, because clearly if you lost a lot, then maybe you didn't have it spread the way it should be.
Ah, okay. Interesting. Karen?
Yeah, Kim, does that just open investors up to even more risk because no one's entirely confident that equities will bounce back further in 2010?
Well, that's exactly right. I think it's interesting if you see the MasterCard Consumer Confidence Index that was recently published, and what that indicates is a huge disparity between the confidence that we have in Asia Pacific as customers, with the exception of Japan, I might add, compared to the Western markets, which are quite depressed. And listening to our colleague here in New York previously talking about the risks and the threats that they feel under, you know, and yet in Asia, people tend to be more bullish, you know. So under normal circumstances, I would say, yes, we would be worried. But remember that baby boomers have been through this before. It's not like this is the first time we've suffered, you know, losses and financial crisis. We've been through it before. We know it will recover somehow. And I think the thing is that as we go forward, we're going to be looking for some more surety. These sort of more esoteric investment vehicles that have come undone over the past 12 months, we're going to be looking at those through a microscope, and not even just the vehicles themselves, but the institutions that back them.
Okay, surety. Where do you find it these days?
Well, I don't think you find it anywhere, but I suspect that if we tie the whole notion of surety with the Asian need to sort of pass on to next generation, I think property.
Bricks and mortar.
Yeah, bricks and mortar, absolutely. And I think if you look at what the property markets have done around Asia, look at Singapore, for example, incredibly overheated right now. But I think a lot of that money is going in there at the expense of, you know, other investment vehicles. Because even if it rises and falls...
Let's just bring Phil back in here, if I can jump in, Kim.
Yes.
I know that Phil is not overly optimistic about residential, but a similar theme, what we're really talking about here, is perhaps chasing yield rather than capital growth. Do you think, Phil, that that is what a balanced portfolio looks like in 2010, something that has a bit of yield?
Well, it's very difficult at this point with interest rates still very low and with the threat of inflation. So if you're going out anywhere further out on the curve, you know, you really could be sitting for some tough times. If rates do really start to back up, which we know they're going to have to at some point, you know, you could lose a lot of your principal. So it's a very challenging time right now if you're looking for yields, because you really need to stay close in but you're not really getting much for that. So investors are really in a tricky spot.
Indeed, tough position to be in. Okay, guys, we got to go. Great talking to both of you. We're going to take a quick break on Squawk Box. We are coming right back. Don't go away.